introductions and be respectful of your time. Wanted to introduce myself. Assalamu alaikum, everyone. My name is Muhi Khwaja. I'm a co-founder and director of development and philanthropy at the American Muslim Fund. We're really happy to be hosting this webinar today on estate planning, tax avoidance, and charitable giving. I will go ahead and introduce each of our panelists, and they'll say a little bit more about themselves. So a little bit more about myself. I was born and raised in Michigan, went to the University of Michigan Dearborn for undergrad, did an internship in development and fundraising with the University of Michigan, and really saw how the university fundraised with over 500 staff just for the university to be fundraising from their medical hospital through their alumni relations, the sports teams, and everything in between. So it was really eye-opening to see development and philanthropy and fundraising as a career opportunity. And I went to work at the Institute for Social Policy and Understanding. After that, did my master's back at the University of Michigan in nonprofit management and public administration, worked at Tetleaf Collective, and went over to the American Red Cross as well. So after working at the American Red Cross for 5 years, now I'm working full-time at American Muslim Fund, and really excited to be taking this opportunity to help the Muslim community be more strategic in their charitable giving. Gina, why don't you go ahead and introduce yourself as well?
Assalamu alaikum. My name is Gina Shkoukani. I'm a fourth-year associate at a firm called Neal, Gerber, Eisenberg in Chicago. I'm actually also from Michigan, born and raised. I went to undergrad and law school at Wayne State University in Detroit. I started my career at a firm called Haque, also located in Detroit, in 2016. I was there for about a year and a half, and then my husband and I decided to have a change of scenery and to pursue other career opportunities in Chicago. So I've been here now almost 2 years next month. I honestly got into estate planning after my second summer when I was just thinking about what opportunities my community needs and what I can get involved in. And so estate planning kind of seemed like a niche market with the growing Muslim American community, the fact that the net worth of the Muslim American community was continuously growing, and the fact that there was a huge charitable component of estate planning. I thought that this would be a niche market that I could get involved in. And so now I've been involved in now for 4 years.
Wonderful. And Maseer, why don't you go ahead and introduce yourself?
Hey, assalamu alaikum, everyone. My name is Maseer Rabbaig. I'm a CPA. also from Michigan, and then I did my undergrad at Dearborn for a couple of years and transferred to Ann Arbor. I've known Muhi for quite a while. Says about his passion for this work, I can definitely vouch for that. I did my master's in accounting at Wayne State, got my CPA license after that, and I've been working in public accounting, public governmental accounting for the past 10 years. I decided to start my own shop. So me and a friend of mine, also a CPA, we created our own little accounting firm, and we kind of help. Our focus right now, and the area we're working with right now, is nonprofits and kind of personal taxes and the mix of the two.
Wonderful. Thank you, Maseer. And Fatima, please introduce yourself as well.
Thanks, Muhi. Assalamu alaikum, everyone. My name is Fatima Iqbal. I'm an investment strategist and financial planner with Azzad Asset Management. So I'm a little unique. I'm not from Michigan. I actually grew up in Kentucky. And I did my undergraduate at Cornell University in applied economics and management. And then I did a master's in finance at the Rochester Institute of Technology. I got my certified financial planner designation, and I started working at Azzad Asset Management in 2008, which was right before the financial crisis. So definitely an interesting time to start this career path. But really my focus has been on socially responsible and halal investing in financial planning. And similarly, I started that journey probably in undergraduate when, I started trying to find ways that I could focused my interest in business and finance and the nonprofit sector. And from that, it grew into kind of an interest in socially responsible entrepreneurship and business opportunities. And finally, I saw kind of all of that culminating with my work that I do at Azzad, where again, we focus on halal financial planning, which is also socially responsible. And then we also, kind of do additional work when it comes to shareholder advocacy. And really, again, trying to help the community, bring more strategic work when it comes to both their giving and also kind of building our community.
Wonderful. I'm really excited for this conversation to take place. Just a few housekeeping items. If you are on the call, please be on mute until the Q&A section when you'll have an opportunity to share some questions. Please use the chat feature to ask any questions if you're online. And inshallah, we'll go ahead and dive into it. So first up, we have Gina, who will be talking about estate planning and some of the best practices. Gina, take it away.
Okay. Go ahead, go to the next slide. Okay. So when an individual comes in to meet with me to discuss their estate plan, we're really focusing on 4 estate planning essentials. So we're talking about a will, a revocable trust, a durable power of attorney for property, and also a durable power of attorney for healthcare. A lot of individuals, when they think of a will, it's a document that they need in order to write who takes their assets upon their death. This is correct. However, if an individual just has a will, they're actually still subject to probate. So generally speaking, a will acts as a document that will dispose of all your probate estate, meaning any assets that are in your individual name, that is what a will can dispose of. So for instance, if you have a retirement account or a life insurance policy that has named beneficiaries, those assets do not fall within your probate estate. Also, if you have a bank account that with both your name and your spouse's name on this account, or you have a home, again, in two individuals' names, that will also be outside of your probate estate. It's just any type of asset that you have in your name. So the problem is that when you have to go to probate, a lot of individuals like to avoid it because, one, it's expensive. You have to hire an attorney, which obviously is good in my sense, but you're dealing with the court, you're dealing with their timeline. You have to notify creditors that you have passed, your executor has to notify creditors that you have passed away. It just provides unneeded notice. So in order to avoid probate and all of this headache, what we do is we use your will to basically state that upon your death, all of your assets will be distributed in accordance to the provisions of your revocable trust, meaning that your revocable trust becomes the beneficiary. And the other benefit of your will is if you have minor children, this is the document that you use to designate your guardians. So really, again, the will just becomes the purpose of designating your will as your revocable trust as the beneficiary, and then designating guardians. Really, the core of estate planning comes down to your revocable trust. Your revocable trust is going to explain exactly how you want your assets to go upon your death. You can name charity, individuals, anything that you would like, and we're going to go into those details in just a bit. The next set of documents, your durable power of attorney for property and your durable power of attorney for healthcare, these documents are actually relevant during your lifetime. So basically, you are appointing agents to act when you are no longer able to act for yourself in terms of your healthcare power. So for instance, you're going to nominate an agent. So in the event you become incapacitated, your agent will know exactly your wishes, whether you would like to be on life support, whether you would not like to be on life support. These documents are really important for, honestly, any individual over the age of 18. So for parents who have, for instance, children who they still would like to be able to speak with their doctors, it's really important to have a healthcare power of appointment. The durable power of attorney for property is interesting. Some individuals only have it activated upon incapacity as well. The problem with this is, generally speaking, if you become incapacitated, you want your agent to quickly be able to speak with your credit card company, your mortgage provider, withdraw money from the bank to pay the bills, things of that sort. If you only have it kick in upon incapacity, then your agent is required to get documentation from your doctor and then get it certified by the court, and it just prolongs the process, when in reality the whole point of having the document is for it to be useful at that emergency, at the time of the emergency. So how we draft this document is that it actually becomes effective upon signing. So generally speaking, we see our clients nominating their spouse, their children, their parents, basically any individual or individuals whom they trust that can act just as they would in terms of any financial obligations. Muhi, can you go to the next slide, please? So this is an illustration of the estate planning flowchart. So this really shows how the flow of assets go upon your death. So again, your will, you're going to nominate an executor to administer your probate estate, assuming that you have any assets left over in your individual name. That individual will gather everything, title everything to the name of your trust. Again, if you have guardians named upon your death, those guardians will be nominated by the court and start acting in that capacity. And then your revocable trust. This again is really the core of what we're dealing with. So in this case, during your lifetime, your revocable trust really does not do much. So you can still do whatever you would like with your assets, and you are not restricted by this document. You can, for instance, name and amend and revoke throughout your lifetime. So we have clients that have amended their revocable trust 30 times throughout their life. They name a trustee, they don't like the trustee, they like their child, they don't like their child. Every day you could amend it if you would like. So that's what's nice about this document. So let's deal with it upon your death. So when you pass away, your successor trustee, whoever your name, is going to be responsible for administering this document in accordance with the terms. So you want to nominate an individual or a corporate fiduciary to act that you trust. And these individuals will be responsible for paying off all your taxes beforehand, and anything remaining is going to go in accordance to your beneficiaries. So a typical plan that we do will have a specific amount, for instance, going to charity. So as a Muslim, you can, if you're going in accordance with Sharia law, you can donate up to 1/3 of your assets. So for instance, you may decide, I want 1/3 specifically going to a charity, and that trustee will be responsible for writing a check to that charity upon your death. And then, for instance, anything remaining, you may want to be held in a trust for your spouse. And the provisions of that trust will be dependent upon the tax effectiveness. So, for instance, there's certain language that we need to include within the trust agreement to protect it from estate taxes, and I'll go into that in just a moment. You also want to have it limited for creditor protection. So, for instance, generally speaking, we give the surviving spouse what's called a right to income, at least annually. So they have full right to income, and then we restrict principal distributions to a standard, typically a support and healthcare standard. And what we also provide a spouse, generally speaking, is what's called a testamentary or lifetime power of appointment, meaning that if they want to take the assets that they have in their name now in this trust and give it to specific individuals or charity, they have the right to do so. And again, you can restrict that that power to whatever you would like. So, for instance, generally speaking, we have a power of appointment usually to charity and the grantor's descendants, and the grantor is the individual whose revocable trust we're dealing with. So, for instance, in terms of your trust, it would be to your descendants and charity. So if your surviving spouse says, you know what, I want to give a little bit more to charity, they can do so through that power. Upon your spouse's death, then, anything remaining, anything that was not given away through that power of appointment, will be distributed if you decide to equally amongst your children, for instance. And again, your children will have similar provisions. They will be provided income and principal in accordance to a standard, so you have a support and a best interest standard, again, for creditor protection purposes and to keep it out of their estate. And they also, too, may have the ability to have a lifetime limited power of appointment, again, if they would like to pursue their charitable purposes, and you can limit that to 1/3, for instance, if you'd like. And again, if you look to your left, you have your durable power of attorney. Again, as I discussed, these are your lifetime documents that you're dealing with. There's also a living will declaration, and those are for individuals who would like to withdraw death delaying procedures. And if that comports with your wishes, this is an additional document that can also be signed within your estate plan. Can you go to the next slide, Muhi, please? So in terms of drafting your revocable trust, a lot of individuals do this for tax purposes. So generally speaking, an individual can be subject to estate tax, gift tax, and GST tax. I'm not going to get into GST tax, but it's important to note that any individual who has assets that are more than $11,400,000, they are actually subject to what is called federal estate taxes, meaning that the assets that are above that are roughly subject to about 40% worth of taxes. So I know many of you are thinking, holy crap, I'm not subject to this. I'm $11 million does not seem like you're going to be within your foreseeable future. However, it is really important to note that we have a Republican as our president right now. At one point within the last 10 years, the federal exemption was only $1 million, I believe. So just because you are not subject to this estate tax currently does not mean that you are not subject to it later on. And also, each state does things a little bit differently. But in Illinois, in addition to the federal estate tax, there's also what's called a state estate tax, meaning that any individual with assets over $4 million, they are also subject to a state estate tax. This is why we may create more than one trust for a surviving spouse, for instance, to do what is called a Q-tip election, meaning that with specific provisions for tax effectiveness, it allows that upon the first spouse to die, they are not subject to the state estate tax, and only upon the second to die will the state estate tax kick in. What's good to know is that an individual can donate as much as they would like to charity, and there is no, and this does not go against their federal exemption. So basically, there are a few things that you can do with your money during your lifetime that does not affect this exemption amount. For instance, you can pay for your children's education. If you pay the tuition directly to the college, that does not affect your exemption amount. Again, gifts to charity does not affect your exemption amount, and neither does amounts for medical expenses if it's paid directly to your insurance provider or the hospital. You can gift throughout your lifetime to any individual, but you're restricted each year to $15,000. So if you decide to give $20,000, that extra $5,000 is actually going to start to take away from your exemption amount. So, for instance, if you decide you have an extra $1 million, for instance, and you give that away during your lifetime, you now no longer have $11,400,000, but you now have $10,400,000. So some individuals actually use the full amount of their exemption throughout their life. So when they die, any assets that they die with will be subject to that federal estate tax 40% rate. So again, this may not be relevant to you right now, but it is something to think about depending on who our president is next year, and we're all hoping for the best. Again, feel free to ask me any questions, contact me, email me if you are thinking about an estate plan. Thank you.
Wonderful. Thank you so much, Gina, and really insightful information. Maseer, why don't you take it away so you can talk about some financial planning. Maseer, you might be on mute. Okay. Let's see. Apologize for the technical difficulty. Maseer, just join in again and it should fix itself. Sorry about that. Welcome back, Maseer. And we should be able to get things going now.
But yeah, like I said, when I introduced myself before, my name is Maseer. So we'll be talking about charitable donations on your personal taxes. So, next slide. And we're going to start off with some definitions here. Tax credit. So a tax credit is something that reduces your taxes directly, dollar for dollar. An example of that would be lifetime learning credit, which if you qualify, would reduce your taxes by $2,000 at most annually. The next is a tax exemption, which most of these are personal exemptions. So, for example, each person on your tax return is entitled to a personal exemption. Your spouse, your dependents, those are all personal exemptions. However, the new tax law took these away and increased the standard deduction. And then the last definition we'll be looking at is a deduction. And there are two types of deductions. And there are adjustments to income, which are always helpful because they reduce your AGI, and a lot of your tax rate is based on your AGI. So, for example, if you contribute to a regular IRA, that reduces your AGI. And then the other type of deduction is an itemized deduction. And itemized deductions are only helpful if they're greater than your standard deduction. And an example of an itemized deduction are gifts to charity. So the next slide, just sort of a general takeaway is deductions and exemptions reduce your taxable income, but your credits reduce your tax that you owe. And the only way you can use charitable contributions to deduct on your personal taxes is through an itemized deduction. I see that AGI means adjusted gross income. So the way it works is all your taxable income gets put into one pool. And if you have any of those tax deductions that reduce your AGI, like your charitable, like a contribution to your regular IRA, your AGI gets reduced by that deduction, and then your tax rate, whatever your income is, whatever that amount is, your tax rate is based off of that amount. Yep, so next slide. What qualifies of the charitable contribution. So the IRS definition of a charitable contribution is a donation or a gift. And voluntary is made without getting or expecting to get anything of equal value. So we have to look at two things here. The donation or gift, which can amount to either money or property. But the issue with that is, the issue with all of it is that it's subject to limits. And then the other thing we have to define is the qualified charitable organization. Those are defined as something that's organized and operated exclusively for exempt purposes. And then what's an exempt purpose? So a lot of common purposes include a religious organization, educational institution, or scientific institution. But I mean, a lot of, we know most of the charitable organizations, your local mosque, Red Cross, Islamic Relief, those types of organizations. So, next slide is what is deductible. So money, we got two things, money or property. So we'll talk about money first. So it's pretty much dollar for dollar, whatever you contribute is considered deductible. But if you receive a benefit from it, you must subtract that value from your payment. So for example, if you bought a ticket for a dinner, $50 ticket for a dinner, and the dinner has a $20 value, your charitable contribution is $30. You do not get to deduct the full $50 as a charitable contribution. And then if you donate property, the general rule for property is the fair market value of the property that is being donated can be deducted. Fair market value is defined as the price at which a property would change hands between a willing buyer and a willing seller, neither having to buy or sell, and both having reasonable knowledge of all the relevant facts. So meaning you can't, you can go to eBay or Craigslist or something, and if you both know what you're getting into or what you're buying or selling, then that is considered generally fair market value. An example is if you donate your car, fair market value of $6,000, that $6,000 is deductible. So with deductions and with charitable contributions, there are limits. Your general rule is you can deduct cash contributions no more than 60% of your AGI, but there are different other limits that the IRS imposes. There's a 50% AGI limit if you donate to churches, synagogues, mosques, educational organizations, and hospitals. So if you're donating to those strictly, then your AGI limit, then your limit is 50% of your AGI. For donated property, the general rule is 50% of AGI. However, there's a 30% limit on capital gains. And then what happens if you go beyond these limits? Well, the good thing is you don't lose your deduction. You can carry it over to the next 5 years. But after those 5 years is up and you still have a carry forward, then you lose it. Now, record retention. So a lot of times the IRS, if they see those big donations or see big amounts, they want receipts. So for best practices for cash contributions, you keep a canceled check or a bank or a credit card statement if you donated through those, and then the charitable organization should send you a receipt if it's over $250, I believe. But you just got to keep all those handy in case the IRS comes asking. For non-cash contributions, meaning property that you donate, we kind of have 4 different levels here. So if it's less than $250, there's a receipt that shows the name and address of the organization, data contribution, description of the donated property. If you donated something for $250 to $500 range, the same as the above, plus a statement that says whether you received something in return for your contribution and a good faith estimate of the value of the things that you received in return. If it's $500 to $5,000, it's the same as the above, plus you how you got the property, the date you got in, the cost, or your basis of the property. And if it's above 5,000, you have to do all of the above plus get an appraisal for the value of the property. And that's it for me. So if you have any questions, leave it in the comments, and I'm sure we'll get to those.
Wonderful. Thank you, Maseer. Fatima, why don't you take it away on financial planning?
Great. Thanks again for having me. So we can go to the first slide, Muhi. I talked a little bit about this in the beginning, but just a little bit about the firm that I work with. I work for Azzad Asset Management. And again, as I mentioned, we focus on socially responsible halal investment and financial planning. So I'm going to touch a little bit on that in some of my remarks. But again, that's kind of the expertise that we have, kind of a niche market. And we do a lot of charitable planning. We actually calculate our clients' zakah for the accounts we manage for them, as well as their purification. So really charity and charitable giving is really a built-in part of kind of all of the advice and services that we offer. So today I actually wanted to go through some financial pitfalls. So we can go to the next slide. And I thought I'd cover kind of 7 pitfalls that I see people engaging in, and really some things that I think would be really helpful for people to avoid. So we'll talk a little bit about investing without a plan, cash flow bleeding, leaving money for Uncle Sam, choosing the wrong advisors, timing the market, giving without a plan, and compromising halal returns and for sacrificing your values. So the first mistake is really investing without a plan. So whenever you start investing, think of it a lot like starting to drive. And when you're investing without a plan, it's like driving without a map. So when you're starting to invest, really you can think about SMART goal-based planning. And SMART here stands for specific, measurable, attainable, relevant, and timely. So for your goals, you really should be specific. So it should be something that's clearly defined and described in detail. For example, what exactly do you want to accomplish? Do you want to save for your child's college? That's not going to be very specific. But if you say, I want to save the cost of 4 years at X university by the time my daughter turns 17, now that's something that's clearly defined. The other thing is it should be measurable. So you should be able to track your progress and know when you've reached your goal. Attainable goal is something that's also going to be realistic and reasonable. So of course, we might find some goals to be challenging, but you should have a fair chance of achieving them. So everyone would be happy to say, oh, I'd love to have $1 million in 5 years, but really how attainable is that? But if you say, well, I want to save $1 million in 30 years by the time I retire, that actually may be attainable. And then a relevant goal is one that makes sense to you. And timely is one that you can set a time frame or a deadline on. If we go to the next slide, it's also important to remember that the key to success is not picking an investment strategy, but really in developing a strategy that suits you. So remember that risk comes hand in hand with return. And of course, if someone's guaranteeing you a return, be very cautious. Really, I would advise run away. Anyone can brag about an investment based on a high rate of return, but rarely anyone will talk about the loss they're willing and capable to withstand. So here I've outlined 2 terms, risk tolerance and risk capacity. Risk tolerance is your emotional tolerance to withstand losses without panicking. Now that's really important to know so that if the market starts fluctuating, and it will, that you're not below your risk tolerance and in a position where you're going to panic. The other term is risk capacity, which is actually your financial ability to withstand losses without changing your lifestyle. So the question is, well, if the market drops 20%, am I just going to panic because I don't like seeing my account value that low? Or is it really going to affect me by changing something within my lifestyle? Am I no longer going to be able to send my kids to college? Am I no longer going to be able to pay for my retirement expense? And next slide also talks about media hype. So you're definitely probably going to be hearing various kinds of advice from different TV pundits. And of course, a lot of it is going to be more hype than reality, and probably more about improving their rating than really real advice that's for you. So for long-term investors, stick to that plan once you've developed it, regardless of volatility, because remember, your plan should be based on your goals and your risk appetite. So the next mistake is actually cash flow bleeding. So, how much money you make doesn't really determine whether or not you achieve your financial goals. You could make $1 million and you could still fall heavily into debt. Or on the other hand, you could make relatively less money and be able to retire with a comfortable nest egg. What matters is not how much you make, but really how much you're able to keep. So the first step is eliminating the unnecessary. Really know where your spending is. Remember that spending is a behavior. And you can start tracking that. There's a number of apps out there these days that are good aggregators like Mint.com and Good Budget. So regardless of how much somebody earns, they really should have a personal budget. The other item is streamlining that spending. So really, again, knowing what you're buying and for what reason. The third point is investing first and then spending what's left. So successful people, again, are investing their money before they spend it. With every paycheck, they're putting some of their money into their retirement plan, into a child's college fund, into an investment account. And this way, not only do they control their spending habits, they're also investing their money so it can potentially grow for them. And of course, they're only spending from what is left. And the fourth and last point here is getting rid of debt. Again, people who really are able to succeed financially, they really look at debt as a four-letter word. People that are really trying to pay off their mortgage as quickly as possible, getting out of student debt as quickly as possible, and not borrowing on their credit cards unless they can pay it off immediately. Looking at the next slide, the next question a lot of investors have, well, when is the best time to invest? And the answer really is to invest sooner than later. So if you take a look at this graph, you'll see how investing just $3,000 per year at 6% return will grow over a certain time period. So if you start at age 20, by the time you're 65, you've accumulated almost $700,000. If you wait until you're about 35, that number accumulates to only around $250,000. And if you wait till age 45, it's only $120,000. So the lesson here is really starting a strategic investment approach as early as possible. Of course, it's never too late, but the earlier you can start, the better. Going into mistake number 3, now this is leaving money for Uncle Sam, and this is, again, going back to talking about taxes and paying more than you have to in taxes. There are a lot of different options that you can probably discuss with your CPA about how to save money from taxes. One of them is definitely maximizing your retirement savings. So if you have a 401k through work, that's a great place to start. There are higher contribution limits on 401ks. But if you don't, you can also use an individual retirement account or an IRA. Right now is also the season to harvest portfolio losses. This has been a strong bull market. The market is relatively high, so you may not have a lot of losses sitting in your portfolio, but if you do, you could sell some of your portfolio at a loss, and you can actually reap the tax benefit. Another idea is to do Roth conversions. Now, a Roth account is a retirement account that also grows tax deferred, but it's post-tax. And so when you pull the money out, you're going to get to take that money tax-free. Donating appreciated securities rather than cash is another great way to, again, save on taxes and also really increase the amount of charities that you're able to give. And finally, once somebody reaches age 70 and a half, they can donate their RMD or their required minimum distribution directly to charity as well. So this is just an illustration of why you should consider retirement accounts or other types of tax deferral. Tax deferral basically means that you don't have to pay taxes on the account as it grows. So again, in this example, if you've invested $10,000 in year one, and you compare it to an account which is a taxable investment account, like a joint account or individual account, versus a tax-deferred investment, you can definitely see how the tax deferral can end up allowing you to save significantly more in your account. The next mistake that we'll talk about is, again, choosing the wrong advisor. So whether you're, again, creating a retirement plan or investing for yourself and your family, you're going to most likely end up hiring some sort of financial professional to work with, like a financial advisor, an accountant, maybe an attorney. And if you're managing your own retirement plan, maybe a third-party administrator. So before you hire somebody to join your team, it's really important to take a look and understand their qualifications and credentials. You won't imagine how many times a new client has come to us and really didn't take a closer look at their previous advisor. But here are some resources where you can go and actually check those credentials, see if they're valid and if they're up to date. For example, for investment advisors like us, you can check the FINRA website. And of course, you should make sure you understand how members of your financial team are compensated, whether that's based on commissions or fees, and whether those fees might be hidden within products, and again, what's being charged on top. On the next slide, I just have some red flags to consider whenever you're talking to an advisor. If they promise you any of these things, be very, very aware. Definitely don't ignore these flags. If they're coming and talking about high investments with little or no risk, or really consistent returns, saying I can guarantee you, 8% every year. If they're unregistered investments or sellers, if it's something you really can't understand, if it just seems too complex, and say, don't worry about it. I know it's really complicated, but it's a really good idea. Definitely be cautious. If there's any issues with paperwork or cashing out, or you feel that their fees are unjustified, again, definitely pause before you decide to move forward, no matter really how the returns might sound. So going to mistake number 5, a lot of people are talking about this right now since the market has become a little bit more volatile, and we've really seen the market grown significantly over the past 8 or so years in this bull market. And people are starting to talk about timing the market, or really should they try to predict the best time to buy or sell. Now, this is something that's virtually impossible for investors to do, even professionals, especially to do effectively. And really successful long-term investors understand the stock market does rise and it does fall. And the only way to profit when the market rebounds is really to stay invested when it drops. So if we go to the next slide, there's some interesting statistics to see how your account could be affected if you miss just the best few days each year. Now, this is an example showing a hypothetical $10,000 invested in the S&P 500 between 2005 and 2017. Now, if you stayed continually invested during that time, you would have an annualized return of about 9.3%. But if you miss just the best day each year, the return would only be 4.9%. And if you miss the 2 best days each year, it would drop to about 1.19%. So hopefully that just illustrates how important it is to create a plan, make sure that you can stay invested for your time horizon, and again, not time the market. So mistake number 6 I wanted to talk about was giving without a plan. And just like how we say it's important to have a plan when it comes to your retirement or your children's college education savings, really it's important to have a plan when you talk about your charitable dollars. So one point that, again, we often are automatically talking about is when it comes to our zakat. So making sure that we're accurately calculating our zakat, and that way we know how much money exactly we have to give to zakat-eligible charitable causes, and how much we have maybe for sadaqah or other causes which may not necessarily be zakat-eligible. And then really understanding ways that you can make smarter gifts. That could be through donating stocks, using donor-advised funds, or using charitable trusts. So we don't have a lot of time to go into a lot of detail about zakat, but these are just some of the assets that are zakatable that you would owe zakat on if you hold. For example, gold and silver, cash, assets that you are intending to trade or sell, and current good debt, livestock, crops, and minerals. So the last 2 probably most people don't have a lot of those in their portfolios, but certainly assets that you're intending to trade or sell, like growth stocks or cash. The next slide has non-zakatable assets. So these are assets, if you hold them, you actually don't have to pay zakat on. And those include property, personal use property like your personal residence, cars, furniture, any sort of capital goods, which is maybe like equipment or property that's used for a business to generate income, any assets that are intended for retained ownership, like investment properties or income-oriented stocks, and finally, unlawful assets. So if you do have any assets which, again, do not follow the halal guidelines, or they came from something that came from like riba, theft, bribery, gambling proceeds, so on, you actually don't owe zakat on them. So that's another reason why it's important to know, again, how much of your assets are coming from lawful areas and which ones are not. And on the next slide, we do have a webinar that goes into much more detail on our website at azzadfunds.com. So feel free to check it out if you'd like to learn more. But the other area which you can use to, again, have greater impact in your giving is actually donating appreciated securities. So here I've kind of listed the difference. If you own stock in your portfolio, what happens if you decide to sell those stocks and donate the net proceeds? Of course, you're going to be paying long-term capital gains tax. So that's going to ultimately reduce the amount that goes to charity, and then it's going to reduce ultimately the income tax payments that you get. But if you have shares that you've held in your portfolio for longer than 1 year and they've appreciated, you can consider donating those stocks directly to the charity. In that case, you'll avoid paying the taxes on the gain, and you'll be able to deduct the current market value of the stock. So let's say if you bought them originally for $15, now it's appreciated to $50, you actually get a deduction of $50,000. You don't have to pay any taxes, and now you've benefited the charity by giving them $50,000, of which only $15,000 you actually put in. So again, another way to amplify your charity. And the next slide just shows an illustration for how donor-advised funds work. I know Muhi's going to talk a little bit more about that. But if you don't have a charity necessarily right now, it's coming near the end of the year that you want to, give donate appreciated shares to, you can use a donor-advised fund to do this. And a donor-advised fund will then give you flexibility to be able to take the deduction in the year you contribute to the donor-advised fund, but actually pay out to charity in subsequent years. So it's another great way to align your charitable giving with your tax planning. So you make the contributions, get the tax deductions in the years you need it, and then pay out to charity to align for when you actually want the money to go to. And the last idea is like a charitable lead trust. Now there's many different types of trusts. Two common ones are charitable remainder trust and charitable lead trust. But again, these are ways that you can really try to achieve more than one financial goal through a trust. So with this type of trust, you can actually benefit charity for a certain term. And as the money grows in the account, whatever is remaining at the end of the term can actually return back to you or your family. So this is another great way to align tax deductions with your charitable giving. I quickly just want to go into the last mistake that I highlighted, which is compromising your values. So with this, if you're investing in ETFs and mutual funds, it's really important to know what you're investing in. It's important to also understand the rules of riba-free investing. Not having, the fact that there's no long-term investment penalty for halal investing. There's a lot of good options out there now that you don't have to sacrifice your performance for halal. And finally, eliminating the haram from your portfolio. So I just want to give a quick example of, oftentimes we think, we know we should avoid, companies maybe that are selling alcohol or dealing in casinos. But here's an example of a technology stock, for example. This is Apple, and we just put it through our investment screening and filtering application, and actually passes. We take a look and see what the line of business is, and then we also take a look at the financial ratios. Does it have significant debt? Does it have excessive cash? Does it have any significant income coming from interest? And in this case, Apple is a technology company, and it passes all of these thresholds. But if we take a look at the second example, this is IBM. And although it's a technology stock, in this case, it actually fails the guidelines. And the reason that it fails is basically because IBM has a credit wing. And so, of course, they're deriving more significant revenue coming from interest. So again, it's not always obvious whenever a company might be failing. And definitely there are halal funds out there and resources that can help you with this. And final slide was just red flags to identify riba and haram. So if you hear any of these, definitely be cautious. If it seems like somehow money is guaranteed to grow just by the mere passage of time, that's probably a red flag that this is riba. If you also hear terms like risk-free and guaranteed, if the growth is not based on the actual use of an underlying asset, product, or service, if interest or money is growing by lending and borrowing, if there's any trading of debt or trading of investments with significant debt, if there's situations where there's one clear winner and one clear loser, and I think the most common way that we see this or recognize this is in gambling, and again, conventional annuity and insurance contracts, which also have those elements of uncertainty and gambling in them. So with that, I'm turning it back over to Muhi. Thanks again.
Wonderful. Thank you so much, Fatima, for all of that information. And we'll be sure to share this presentation afterwards so everybody has access to the slides. And even the portion in which I'm going to be talking about is taken from our website, and you can find the full version of this presentation from American Muslim Fund on our website as well. So jumping into it, these are some of the things that often motivate donors to support a cause. Each of you are passionate about making a difference in your local communities when you want to donate. And, everybody wants to make a difference with their charitable giving, whether it's $50 or $50,000. Everybody wants to make sure that when they give to a cause, it is making a difference. I think a lot of the times we necessarily don't look into the fact that it actually makes us feel better when we're helping other people. And that personal satisfaction is actually a big motivator for people making charitable gifts as well. If your family has a history or a practice of volunteering or donating, or, if you yourselves have kids, or when you were a kid, your parents gave you money to put into the donation box, right? All of those things impact the way and the reason why we donate ourselves. And then, you may have a personal story of maybe visiting a location where you were helping out a community, and you come back with that story to motivate other people to give. And of course, in Islam, there is such a significant importance on giving sadaqah, giving zakat. And obviously, zakat is one of the pillars in Islam. It's mentioned over 30 times in the Quran, especially with prayer. So being combined with another pillar of Islam, you see the significance and the importance. And there's stories of the Sahaba and the prophets and competing in their charitable giving, right? So, things like our social network also influence sometimes the way we give. And last but not least, the tax benefits, which we've been talking about as well. But some of the reasons why people do not give, the main reason is they weren't asked. So, when we actually invite people to participate and make a donation, they're more likely to give rather than them making the decision on their own. And the other reason why people tend not to support a cause is because they think that their gift does not matter. And, the power of charitable giving and the power of participating actually speaks a lot of volumes in the movements that end up becoming viral, right? Or even for a cause that may not be as well known, those individual gifts are a lot more meaningful. So I wanted to provide some insights on the American Muslim community, and these stats were derived from Pew Research in 2018. So as you can see, the American Muslim community is a conglomerate of many minorities across the spectrum. And we have a long-standing history of Islam in America that, even the practices of sadaqah began on the plantation fields when some of the slaves would give out saraka cakes or rice cakes that was a practice in West Africa to as a means of sadaqah, right? So we have this long-rooted history of charitable giving, not only in Islam but also in America, that we need to better understand so that it can further influence the way that we give as well. There are over 700 community foundations across the United States, but none of them were reflective of the American Muslim community. So when I started working at the American Red Cross, I still wanted to be actively involved in the Muslim community and make a difference. I didn't want to recreate the wheel, but I wanted to create an institution that would have long-lasting impact for the entire community overall. And I had learned about organizations like the Jewish Community Federation or the National Christian Foundation that work with a religious identity across the United States to influence charitable giving from their faith perspective. And the Muslim community was missing that, so that's why we created the American Muslim Fund. Some of these stats are from Muslim Advocates and from CARE and Dinar Standard. They've done studies across the American Muslim spectrum. So there are over 1.5 million registered Muslim voters. This is important, obviously, as we head into the presidential election and, making sure that the Muslim community participates and has a voice. There are over 7,500 nonprofit organizations within the Muslim community. And there are over 1 million American nonprofits overall. Some of the things that they share in common are that their budgets, a majority of them, are under $250,000, and that they have less than 2 full-time staff. So when you think about making your charitable gift, you want to find organizations in which you feel those organizations have high impact and also have a certain standard of best practices as well. So there are over 2,000 mosques across the country, and even in the last decade, we've seen a rise in the number of mosques as well. There are over 300 Muslim schools with over 40,000 students, whether it's a part-time weekend school or a full-time elementary through high school. And the other thing as well is that the American Muslim community has $98 billion of disposable income. So when you think of the American Muslim community overall, the wealth is there in order to support not only Muslim causes, but overall charities as well. The research shows that on a minimum level, there are at least 3.75 million Muslims in the United States. And Muslims are a significant community, and they're the largest non-Christian group in over 20 states across the country. And I find this extremely fascinating because even some of the states on there, like Wyoming or North Dakota, I wouldn't have assumed that there were large Muslim populations there. But the Muslim community is widespread across the country. And of course, in the top 10 markets, they're heavily active, but the Muslim community exists all across the country as well. So just a little bit about our journey as American Muslim Fund, and when we started in 2016, we started with a strategic plan of like what we wanted to do and how we wanted to create an impact. So we went through a minimum viable product process to determine our products and services, such as a donor advised fund, giving circles, and endowments and fiscal sponsorship. And I'll get more into that in the next few slides. But this here just kind of provides an overall trajectory of what we've been able to accomplish and how we plan to move forward as well. So another interesting fact is that Americans overall in 2018 gave $427 billion. And it's fascinating to see the growth over the last few years of how Americans make their charitable contributions. We're going to be talking about donor advised funds a little bit. And $30 billion were donated to donor advised funds in 2018, and $19 billion were given out to charities from donor advised funds. And this graph is produced by Indiana University, and they create a report called Giving USA. And every year they track the results of different charities that have received funding, and also by industry. So the top industry that receives charitable gifts is religion. About 29%, that's $124 billion, goes to religious institutions. Next on the list is education. About $58 billion goes to educational institutions. And the graph on the left showcases where the money is coming from. So it says 68% of gifts come from individuals like you and I. Only 5% come from corporations. But the next number on there, 9% come from bequests. So when we talked about estate planning, this 9% is coming from individuals as well. And giving by foundations. A lot of times those are family foundations that are making the contributions up to 18%. So overall, on that pie, 95% of giving is coming from individuals. So for nonprofit organizations, a lot of times they try to focus on multiple types of fundraising efforts, but in reality, the biggest piece of the pie of funding comes from individuals. And it's all about relationship management and moving from transactional experiences to building long-term relationships with your donors. And that's why we created American Muslim Fund, to create positive experiences around fundraising and donating. So some of the core services that we provide: donor advised funds. Fatima shared a little bit about what the vehicle is, and it allows you to make a gift today in 2019 and get the deduction in 2019, but then take time to decide which charities you want to donate to. You can invest the balance for future growth. You can name the donor advised fund after a loved one in memory of someone, or after your family to create a legacy. And you can also be more strategic about receiving proposals from nonprofits to then make your decision with your family and pass on the balance generation to generation and make a larger impact. So giving circles are another form of philanthropy where a group of family, friends, or individuals can come together to support common causes. They would give to, in this instance, American Muslim Fund, and we would hold on to the collective pot of resources, and then nonprofit organizations can submit to that giving circle different proposals and ideas and go through a vetting process, and then be recipients of those funds based on the collective giving circle making a decision to support that charity. One of the other things that we do is research and vetting. There are sites like Charity Navigator and GuideStar that do a fantastic job of looking at the financial resources that an organization has. But we take it a step further to work with the charities. We talk with their staff, with their board of directors. We review their 990 documents and their annual reports. And then we add the charity to our online database on our website, where families who have donor advised funds or giving circles, or just anybody overall, can take a look by grant area and see which charities have received funding from American Muslim Fund as well. One of the other services that we provide are for nonprofit organizations, endowments. So the nonprofit themselves can invest money with American Muslim Fund to make sure that they have sustainability long-term as well. So a little bit more on donor advised funds. Again, you have the flexibility to make decisions after you make your contribution. You can increase your giving potential through investments. You can donate complicated assets such as property or even appreciated assets, stocks or mutual funds, to your donor advised fund to get it started. The minimum to start a donor advised fund is $2,500. And then there are annual fees involved with that. And any charity that you want to support needs to be at a minimum of $100 per transaction. So if you are thinking about opening a donor advised fund, there's a lot of benefit and value to streamlining all of your charitable giving. At the end of the year, you would then receive one tax receipt instead of chasing down all of the nonprofits you support throughout the year. Because as a nonprofit organization, when you donate to American Muslim Fund up front, we would then provide you with the receipt. And this is just a simple example of, if you were donating, even $5,000 or $10,000 a year, you could invest that balance to have future growth, and then make distributions at a later time. So, obviously you want to take advantage of being able to make the most impact with your charitable giving, and a donor advised fund is a simple way for you to do that. So I want to open it up to the audience for questions. Feel free to put your questions into the chat and we'll go through those, or simply go off of mute to ask your questions. And if any of the panelists have any other things that they would like to share at this time as well, feel free to clarify anything as well. A donor advised fund pairs really well with a trust. It pairs really well with investment accounts as a means to do all of your charitable giving through one means. And we have our first question from Hasnat. Is the money put in a DAF invested while it is in the account? And traditionally, the answer is yes. You get to decide, let's say if you're putting in $5,000, you can decide to leave some as a cash balance. However, the advantage to you is to be able to invest that charitable gift as well. And the end recipient of a donor advised fund or a DAF is always a nonprofit institution. And that's why you get the full deduction when you make your gift to a DAF.
I just also add another powerful benefit of a donor advised fund is, let's say you put money in. Now, once the money is in the DAF and it's being invested, it's also growing tax-free. So let's say you put in, $10,000. Let's say, you decide, well, it's going to grow within the DAF, and it's invested, eventually whatever you end up giving out, whether it grows to 15,000 or 20,000, all of that is going to be tax-free growth that you're ultimately now giving to the charity.
Definitely. And another question from Ibad. Can you donate stock assets to a donor advised fund at American Muslim Fund? Definitely. We have a brokerage account, and that's another service that a lot of smaller nonprofits, they may not have the capacity to accept stock gifts. So when you open up a donor advised fund at American Muslim Fund, you can make a gift of stock, whether it's mutual funds or stocks at other companies, and we liquidate those assets for you. So if you make a contribution of multiple stocks to American Muslim Fund to set up your donor advised fund, we would liquidate those stocks, and then you would have the cash balance of the market value of those assets. So then we would give you a receipt immediately to showcase that you made those gifts. And for determining the market value, we simply tell you what the high and low of that stock or mutual fund was on the date of transfer to American Muslim Fund. Then it's up to your CPA or advisor to then give you the full deduction amount of that gift. Once we liquidate those stocks, we will then put them into Sharia compliant investments for you for future growth. And you can determine, again, if you want to have a cash balance or invested balance from that amount. Gina or Maseer, do you have any things that you'd like to share as well?
I think that's it.
Okay. Does anybody else have any questions? Feel free to ask over the phone or put into the chat. Wonderful. Well, you have fantastic resources in Maseer, Gina, Fatima, and myself. If you have any questions about estate planning, charitable giving, how you can be more efficient with your tax planning, feel free to reach out to any of us. And hopefully you found value in the webinar.